Hello, welcome to Talks at Brickstone, your one-stop podcast for research, insights, and interviews on thought leadership issues relating to Africa's infrastructure, built environment, and natural environment. I'm your host, Femi Awufala. In today's episode, we'll be discussing the topic, debt financing for growth companies. I have here with me Mr. Bayo. Mr. Bayo is an economic and investment strategy analyst with extensive experience in covering corporate responsibilities in economic sectors, capital market research, business development and performance management, as well as investment banking. Bayo has had various years of experience in investment banking with a couple of private equity investment management firms, as well as running his own firm now called Sthenic Finance and Advisory Limited. Mr. Bayo is currently the managing director, and his responsibilities include financial advisory activities in origination and structuring products across plain vanilla and special capital raising, M&A and business structuring, etc. Mr. Bayo is a PhD candidate in the Energy Economics and Finance program at the Center of Petroleum Economics, Law, Energy and Law, that is the CPEEL at the University of Ibadan. Please join me to appreciate Mr. Bayo for joining us today.
Good morning. It's a pleasure to be part of Brickstone podcast today. We look forward to an interesting conversation. Thank you.
All right, very good. So today we will be looking at how debt financing, affects growth companies, and this relates to companies that, we call the medium sector companies in a way. And we know that a number of companies today in Nigeria, when they say, I'm looking for funding, what they're actually talking about is they're looking for debt. So I just wanted to share with us your own experience about, the funding atmosphere around these growth companies, and what companies exactly, are these growth companies? I mean, when does a company aspire to call itself a growth company? Thank you.
Mr. Awufala, thank you again for this opportunity to share our experience on the market with you and our great audience, I'm sure. If I'm permitted, I think first is to appreciate the great work that Brickstone is putting up here. One of the major gaps in the market today, Nigeria especially, and particularly across the developing world, is a major gap at accelerating businesses. Technically, entrepreneurship isn't something that is part of our DNA as a people. In the Western world, there are systems, platforms that help generations to get used to how a business is created. That is why it is easier for people to start great businesses that we know today from the car parks of their parents in their home, and they all turn out to be wonderful businesses. Today, millions and millions of such businesses are being created in Africa, but they remain where they are. They cannot scale. They sort of stuck in what we call the missing middle. There is a research in Harvard that's actually supported this, where you see a huge mountain of what you call micro and small businesses, millions and millions of them, and then you don't see businesses in that middle space, the medium size or small businesses of 10, 20 people, and then that are then scaling gradually to become larger multinationals that can grow generationally. And in that space, you see a small molehill, and then you can see that middle between a mountain of large companies, small valley of medium-sized companies, and then a small molehill of large companies that are generically African or those that belong to the developed world. In the Asian continent, they are gradually learning how to do this, and they are building great companies in that manner. In Africa, I think the journey is just beginning for us. So to go back to the great question, at the back of that context, that Mr. Awufala just asked, we have a deluge of companies in Africa in Nigeria in particular that can be called growth companies, and different from startup companies. Startup companies are those ones that, as they are at a stage where they are what we call just outside an idea stage. Outside an idea stage is I've sold my first product or service to 2 or 3 people, constricted or restricted to people that are largely within my relationship cycle, my family cycle. And most startup businesses are what we call POC businesses. They can grow to become large businesses. They can grow to become medium-sized businesses. They can grow to even become small businesses. I'm taking it all the way back. But the first bit that differentiates a startup business, a startup from a growth company first, is the fact that a startup hasn't tested the market, hasn't tested a full gamut of the whole process of fulfillment end to end, and in such manner cannot totally be clear about its cost structure. A growth company, on the other hand, can also be defined as an early stage business as well. It can also be a small business that has been there for more than 3, 4, 5 years, which means it's no more an early stage business, but is delivering numbers at the top line that is in excess of 30%. When I say top line, I mean between the revenue and cost of goods sold, a growth company must be delivering nothing less than 30%. There are growth companies in Africa that are delivering 100% in that space. There are those that are delivering even in excess of 100%. There are not many, but when you run into them, you realize that, look, this is great, especially when it's a service business. The key issue for most growth business really is managing the cost structure immediately after the top line, what we call your middle line. And so differentiating them, a growth company doesn't necessarily have what you call market risk. The product is tested. There are very viable and sustainable buyers. And there are room to scale the business if a bit of a nut and bolt are tightened here and there. Startup, on the other hand, is a business that is really moving through an idea stage and confirming its thesis as a POC run, using what we call below seed funding. I hope this is helpful.
Very, very, very clear, very clear. And the thing about it is the fact that a number of these companies that are growth companies in Nigeria are actually the sweet spots for investors. They really want to tag along, and the risk in terms of investing in those companies has been properly de-risked to a level whereby it's just to get the right capital to ascertain growth going forward. Now, we also hear in Africa, when a young company or a company that has met this criteria of being a growth company has been there for 2 or 3 years, and for some reasons, it now goes to raise capital, and it raises debt capital. And I have examples that happened in the early 2000s in Nigeria before the meltdown in the banking crisis, where you had NPLs rise a lot. But we had a number of food and beverage companies, a number of fast food companies, a number of well-thriving companies. But all of a sudden, they took on this debt loan to scale the growth, but the whole thing went down. So, just from your own experience, investing in debt in companies and things, that when is a company truly ready for debt financing? Now, the question is posed in this way is such that it's not as if the company cannot continue to pay its bills and cannot continue to be a going concern. This debt financing is not being raised because the company, if it doesn't raise it, is going to maybe die. It might lose its market share and things. But when a company takes on a huge amount of or a loan in such a way, what are the things the company should look out for to say, okay, right, we want to do this now? And what are the various options available, for debt funding? Now, they definitely are. The banks are always the first point of call, but we might want to enlighten our audience. What are the other alternatives they can take? So those are just the two things. Maybe we should just share now. Basically, what are the real issues a company should look itself again before going on to raise debt, and what are the options available?
Thank you, Mr. Ufala. It looks like a complex question to ask. What point is a company ready, especially a growth company, ready for debt financing? However, the answer is very simple, plain vanilla financing and investment banking answer. Simple. Capital structure optimization. It's very, very simple. It's as simple as that. However, it is not as simple as that because of the complexity of our environment. Again, part of that has to do with what I would call behavioral economic part of the issue, which is at what point do a business thought, or the owner of the business thinks there's a low hanging fruit for access to money? Everybody tends to want to take money when they say it. And
right.
Whether it is right or wrong,
there's money out there, let's go and get it.
Exactly. So sometimes, especially the instance that you cite around about the 2010, 2008, 2009 issue, it is more of a financing market demand and supply, or credit demand and supply issue. There was a deluge out there. Everybody was chasing everybody with money, and it's so easy to give money to the nearest guy that looks good. And then these entrepreneurs were just loading on money onto their businesses. And ultimately, if we do a deep dive and detailed research of this, one of the gaps we have in the market today is that as well. We will realize that substantial number of these debt were diverted into something else outside of those core businesses.
Okay.
But let us leave that aside and focus on the issues. The worst decision and when a business is ready, even for the debt, for the growth coming for debt, as I said earlier, is about capital structure and optimal capital mix. A business doesn't necessarily need to add financing to itself when there is no need for one.
Yeah, but sometimes in the market, people say, "Oh, there's money in CBN. There's money in this bank. There's money this bank is lending now. Come and take and things." And he doesn't need it at that time. What if at that point in time that money may not be needed, but he can just put it down, and maybe in future he might now need it?
So you are saying you can put an inefficient funding into your business that may not necessarily be generating any commensurate revenue or return on investment to your cost of funding, because you are taking a funding you may need in the future. I'm not sure that way of looking at it, definitely. which is not necessarily what our potential people who are run into problem not haven't done. That's possibly the decision some of people have made. It was a wrong decision. That's the point we need to agree on.
Exactly.
It was a completely wrong decision. You take money. So the way to approach funding, which also goes back to the initial conversation around whether we have had a very good platform for helping business to grow in Africa and helping entrepreneurs to appreciate how to build a proper business. That lacuna is also there. So if you go back to this issue, if a business doesn't go and ask for money or put money in his business when it doesn't need one, now everybody will think business will always need money.
Right.
There are three ways to fund, two classic ways to fund your business. One is organic, one is inorganic. Organic is you using retained earning and running it back into your system all over, and using it to have what you call marginal increase in capacity for financing and increasing your revenue inward. Typically, another way to look at that is what is called working capital turnover impact on your business. For a growth company, and if you are in businesses that allow you to have reasonable float, depending on how much your receivable structures are, you can almost always bootstrap yourself through marginal growth, right? With your working capital turnover at more than 30% top line growth. Again, there will always be your challenges with how you manage your cost midline. don't forget, if you bring in debt into that business at that point in time, your midline, your EBIT margin begin to increase also. I mean, your because you now incur additional cost of financing.
Yeah, your operating profit.
Your operating profit actually begin to increase. Now, a business then goes from so alternatively for inorganic funding, you go to look for money when you need one.
Okay.
There is an opportunistic demand. Your market just expanded. You've just gotten a new customer who is ready to take on large order from you. Let's think about it. The market just opened up. We've just found another area to expand into because you can have an arbitrage opportunity by moving there first.
So let me just take you on that market opening up. Sometimes as entrepreneurs, we say, oh, there's a new demand in the market. Remember the telecom sector, where as a lot of subscribers kept coming in, and we had these fixed wireless companies that just went down over a period of 4 or 5 years. How does an entrepreneur say that, oh, this is the time, market is now opening? Because throughout my own career and life, people are always saying, market is down, market is down. I've never heard anybody say, oh, market is growing now. So we always have this pessimistic view about, when I say market now, I'm talking about the demand for that product or service. When is an entrepreneur might not be too sure. Okay, let's look at oil, for example, oil and gas. A number of them look at oil prices as a key driver for them to make investments and things. Or maybe another industry like food and bev, when there's maybe demand, maybe there's good seasons and there's more agro product. But they might not be able to really pick a way, but to say this industry is now set for good. Or do you just determine in your mind as an entrepreneur saying that I know that it's so complex for me to spot that there's growth in the industry, but I have to take this decision. I have to scale up, and for me to scale, I need funding.
Okay, everything is still up. It still boils down to your need to be to optimize your business structure. Okay. There are competitive action that you take. There are competitive reaction to market or what I would call proactive next to the market. Okay. That are you taking market opportunity when one comes your way. Okay. Now, whichever one you have, there are implications for every of those decisions because it comes with a whole lot of issues: structure, capacity building, spread, your presence, your locational presence. All of these are then tied to your demand for money, including your of course typical working capital expansion that you will see for those demand. Now, all of this must also come back to how that impact on what you call whether is going to remain a growth company in terms of revenue margin, or it will begin to come down as you scale. What we see most of the time is that these analyses are rarely done by people. They just see an opportunity. They quickly think, if I had 3 more people and put a location in Ikeja, and I will quickly collect 10 or more people, 10 or more customers, and then just give me 10 million. I will do this in a fly. Money is just going to be rolling in. It takes you to sit down with an advisor who then ask you basic questions around capacity, presence, the implication on your cost structure, to then realize that your margin you're looking for, the margin this is going to give you isn't as interesting as where you are before. Now, most of these are critical issues that goes into your decision or to even answer the question of when you are ready for debt financing. Now, because also sometimes when those opportunistic expansion comes in, or even if it is a proactive one for competition, like for instance, I have a customer who want to expand presence across some places right now. Okay. And the reason for that is because the business thinks it has a first mover advantage in those locations. Okay. And if it doesn't expand its presence quickly, other people will come and start eroding his market share in that space.
That happens.
Now, that kind of decision is a proactive one. It may not boil down to profitability. It may simply boils down to a defensive action.
Yeah.
Now, defensive action ultimately doesn't necessarily have what you call a short-term benefit, but it may have a medium to long-term benefit once you have the market locked down. So you are playing on customer loyalty, you are playing on the fact that top of mind awareness that you have created by being there, and you are hoping that the people you have had locked down in your market will not be looking for somewhere else. So, those are considerations, but it also boils down to financing and the cost of financing and that impact ultimately, one, on your profile as a growth company primarily, from the impact that has on your cost structure.
Yeah.
Because the impact on your cost structure is what determines whether you're a growth company ultimately or not. Yeah. So that's one bit. Second bit of it is, what do you want to use the money for? That boils down to your capital mix and optimality of the same. Typically, most small businesses does not, or usually don't want to do not think about financing from the point of view of whether I'm funding long-term assets, I'm funding working capital assets. They need 10 million, give me 10 million. Even though that 10 million is coming with a high cost, where once you procure those things, will not be your return on assets goes down immediately. Those considerations doesn't go into most of it. So what companies like ours do is to sit down with you and tear all this into pieces. First, and say, guy, you cannot use a short-term financing or debt to fund capex. That simply sit down in your book, and then the remaining amount you are then using to generate revenue becomes suboptimal. Because the return on assets immediately become constricted. So these are conversations that you can then have and show a company that you are either ready for this gamut of debt or this size of debt. Typically, we advise businesses that, look, except you can find commensurate longer term funding in terms of debt, you do not use debt to fund capital expenditure. First, I think it's a rule of thumb in a way, classic business school advice. However, there are instances where most growth companies sees some sort of capex that are nearly or quasi working capitals in their profile. Sometimes you sit with business and you realize that what you call capex is actually revenue generating in itself, and in a way you can work around it. So that also exists. But ultimately, the thinking is how to optimize debt financing. Optimizing debt financing goes back to your capital mix and how you structure what you are funding. Is a long-term asset versus a short-term asset. And if it's working capital, you can directly link debt to cash flow. You know that you are funding revenue generation straight away. And as money is dropping, you can immediately pay or service your debt alongside. Not that you've gone to put money in a building or a shop that ordinarily the rent that you pay for the next 2 years, you may not be and your revenue hasn't grown in commensurate manner, creates a problem for the business. So basically, that readiness is also a function of one, what you are financing, two, the structure of your book at that point in time. Vis-a-vis whether it's assets you have whether it's capex you are funding or whether it's working capital.
Thank you so much for this clarification, and I think it's really shed a lot of. Hope you've enjoyed the podcast so far. Please note that this episode is in 2 parts, A and B. You've just listened to the first part, and the second part will be available to listen on our website at www.brickstone.africa/podcast. You can just type the title of the episode and you probably find it there. Have a great time.